Hi everyone, this is Andrew Bosserman, author of the Tackling Taxes column in Christmas Trees magazine. This is the first of what I hope to be many video summaries of articles I'm writing in Christmas Trees magazine. This video summary is of the recap of a 4-part series I just finished that went into the life and taxes of our hypothetical Christmas tree farmer, Sam Spruce. We explored all areas, took a comprehensive look from inventory, costs, expenses, income, qualifying for capital gain treatment under IRC 631, and we also looked at some sample tax forms. So this recap is meant to dive deeper into 3 topics which I briefly mentioned some of them in previous articles, but I just didn't have the time to expand upon them because of time and space constraints. And I just wanted to emphasize these and make sure you are aware of these issues going forward. So the first topic is the IRC 631A election. And I've mentioned this before in previous articles, but bears repeating that IRC 631, which allows a Christmas tree grower to subject the majority of their Christmas tree sales to capital gains or lower tax rates. It's the major way that most Christmas tree growers can save money on their taxes. The average Christmas tree grower could probably save a couple $1,000s just preparing their tax return this way and taking advantage of the tax breaks available under Section 631 in the Internal Revenue Code. And actually, the next article I'm going to be writing is going to show how much typical Christmas tree grower could save by preparing their taxes according to this method. But anyways, getting back to the topic in the recap, it's talking about the IRC 631A election. And the election is important because this means you actually have to tell the IRS you want this special capital gain treatment. It's not automatic. You have to check a box on Form T saying you want to elect capital gain treatment under IRC 631A and then prepare your return accordingly. So you want to make sure you check the box electing this treatment and then send in that Form T with the election with your tax return. The second item in the recap article talks about an alternate way of preparing Schedule F. So in Part 4, I showed how the tax return is prepared by putting the capital gain income on Forms 4797 and Schedule D, and then the ordinary income and all their farm income and expenses on Schedule F. However, there's an alternate way which some people in the industry prepare the tax return, and I call it the stumpage method. What happens is that all income, capital and ordinary, go into the gross income on Schedule F. And then an expense, other expenses on Schedule F titled stumpage is subtracted. And this stumpage expense is simply just the value or the sales of the capital gain sales of qualifying Christmas trees. So all the sales that will qualify for capital gain treatment under 631A, which will end up going to Form 4797 and Schedule D. So whatever way you prepare your return, whether it's the way I showed in Part 4 or this special stumpage method, the tax result is the same. It's really just a matter of how it's shown on the return. The best thing to do is look at how you've prepared it in previous years and try to stay consistent. However, you could change to the stumpage method if you wanted to. It might be easier for the IRS to follow because they can see all the income from the farm and then see how ordinary and capital income gets split. But either way, the tax liability is the same, so it really doesn't matter in the end. I just wanted to make you aware of the 2 ways you could really prepare Schedule F. And the third topic in the recap article has to do with the calculation of fair market value and in determining what income is subject to capital gain treatment. So the way I showed in part 4 was that all of the growth for qualifying Christmas tree sales that was attributable to prior years qualified for capital gain treatment. And then the growth attributable to the current year and the year the tree is cut and sold has to be taxed at the higher ordinary rates. And this is based on an IRS publication about timber and Christmas tree sales that showed the treatment this way. However, there's a conflicting case, court case out of the Ninth Circuit, which is the West Coast states, California, Oregon, Washington, some other states over there, that says actually the entire amount of the Christmas tree sales can go to capital gains and none of it has to be taxed at the higher rates. Obviously, this is a lot better because all of the sales of qualifying Christmas trees can get that capital gain rates and you don't have to figure out some portion for the ordinary rates. However, these are conflicting authorities, so it's really unclear what the IRS's position is. It's really best just to talk with your CPA and determine your level of comfort with what method. Obviously, the more conservative way is to do the split like I showed in part 4 and have some of it taxed at the higher ordinary income rates. But there is authority out there for having it all taxed at the lower capital gains rates. So those are the 3 items that I discussed in my recap article. I hope you enjoyed this video and hope to do more in the future. Please leave a comment if you like this video or if you have any ideas on other topics you'd like me to write on in the future. And I hope to keep posting videos and other articles to my website to help you save money on your taxes as a Christmas tree grower and also make more money.